morning. You're watching Businessworld Live. I'm Danie, Laurel.
And I'm Jess Delos Santos. It's the start of a new trading day, but first, let's go straight to our top story. The country's manufacturing output contracted for the sixth straight month in August. Data from the PSA's monthly integrated survey of selected industries through the Volume of Production Index, or VOPI, showed that factory output contracted 9.9% year on year in August. This was lower than the decline of 14.6% in July, as well as a 12.5% fall in August of last year. The August reading is also the slowest since March 2020. Year to date, the drop in factory output averaged at 12.9%, steeper than the 9.2% slide from the same period a year ago. The PSA attributed the slower downtrend to the rise in two heavily weighed industry groups, which are chemical products and basic metals. 18 out of 20 industry groups posted negative production in August. This includes food manufacturing, tobacco products, and electrical machinery, among others. UANP economist Sid Teroso says the sustained decline can be attributed to the prolonged quarantine conditions amid the pandemic. Meanwhile, over at the Bangko Sentral, Governor Ben Jocno says the slower inflation of 2.3% in September is consistent with its assessment that inflation is expected to remain benign over the policy horizon, with the balance of risks tilting toward the downside due largely to the pandemic. Jocno says that the BSP will continue to evaluate transmission of monetary actions to the economy. All right, Dan, it's looking like a double whammy for our local markets today with weak economic data. Plus, you have negative spillovers from offshore. What's the latest on the global front?
All right, Jess. So a lot of comments from President Donald Trump over in the US. His comments just change on a day-to-day basis, and that has been moving the markets offshore. And if you can see on my screens here, there was a bit of a downtrend in the US over in Wall Street. The Dow Jones down by 1.3%, NASDAQ down by 1.6%. This follows a rally just a few days before, after, of course, it was announced that President Donald Trump would go back to the White House. He was recovering well from COVID-19. And also a lot of speculation from investors saying that because he personally contracted the virus, this might lead to faster fiscal stimulus that might be coming, but that does not seem to be the case. So this is a tweet from President Donald Trump yesterday. He says, I have instructed my representatives to stop negotiating, and that is on the fiscal stimulus, until after the election, when immediately after I win, we will pass a major stimulus bill that focuses on hardworking Americans and small businesses. So basically saying, wala munang fiscal stimulus for the time being until after the elections on November. And that is what shook markets yesterday, especially after these comments came after Jerome Powell, who is, of course, the U.S. Fed chair, said that they need more stimulus and that the economy will stumble without additional support. There's still gaps that are going on. Of course, you've got the Democrats. Their proposal is $2.2 trillion, and the White House is proposing much lower than that, $1.6 trillion. So wala pang nag-agree. Meanwhile, if you take a look at Europe, a bit of a brighter picture there yesterday, even as Germany announced the new cases jumped the most since the month of April. Italy set to order stricter rules. Recall that, France is in a softer lockdown na naman, the UK as well for another 6 months. So it looks like COVID is not over in Europe. Now, let's take a quick peek at Asia. Again, as you mentioned, we might be seeing some spillover effects here from Wall Street, and it does seem to be the case. You've got Japan opening on the back foot, the Nikkei 225 down by 0.5%, and all the way to Taiwan is also in the red. The Kospi as well in South Korea down by 0.12%, and even in Singapore down by 0.2%. So most markets are actually opening in the red. Let's take a quick peek at our own index and how we are performing after we were hoping already to hit the 6,000 levels. It does not seem to be the case. Like you already mentioned, double whammy here as investors digest those new inflation figures, the manufacturing output lowering down by 0.3%. Now we're back at 5,800 levels. We've slid 1.8%. So we basically erased all of those gains from last week in just the past 3 days. Now, what is Jonathan Ravelas? He's from BDO is of course the chief strategist at BDO. He says that inflation print, even as it came well, just the same as what analysts had predicted, 2.3%, shows a still weak economy and anemic consumer demand. And that tempers market optimism for what they are hoping was supposed to be a seasonal pickup in this quarter. The Its household spending usually rises during the Burr months. Jonathan Rivera says that's now that expectation is now being tempered. So again, stocks falling for the second straight day. Now it might be the third, even as there were even lower measures here for the GCQ in Metro Manila. Malls and restaurants and businesses were allowed actually to reopen, and even despite that, our shares still continued that decline. Another thing that was very important, net foreign selling. We lost around 1.09 billion pesos worth of shares in just one day yesterday. So that's, again, dragging us down. It's been 18 straight days of a net foreign outflow. You can see that on my terminal here. Now, let's take a quick peek at some sectors and whether there are some bright spots this morning. It's, of course, Wednesday. It seems to be financials, at least opening with some gains here. That's up by 0.04%. But the rest, particularly property, services, holding firms, and industrials, really bearing the brunt here and being affected by that shakiness in the rest of the region as well. Now, let's take a look at some stocks that were moving yesterday. I'm just going to pull out the Lopez stocks and, of course, ABS-CBN. After we had already reported that it had surged and hit ceiling on Monday, and then the next day, yesterday, was still on the uptrend, even as it had pared back those gains. You can see ABS-CBN now trading at 10 pesos and 52 centavos. Take a look at that, 17% up in just the first 8 minutes of trade today. And that continues that uptrend. And this, of course, after ABS-CBN itself had confirmed those rumors that it will be returning to free TV with Zoe. So Zoe, I don't know if you can say Zoe or Zoe. It's going to now be called A to Z channel. And that's going to be channel 11 on analog TV in Metro Manila and also in other provinces. And this is going to be starting this weekend na. So starting this October, there's going to be a new experience. And this, of course, comes as Zoe is owned by Jesus is Lord, Eddie Villanueva's religious group, and they will be now sharing content of ABS-CBN. So exciting news here, and not just ABS-CBN. Take a look at the Lopez group, which has also gained 4.4% amid, of course, this news. So another one to be watching out for here is San Miguel, and San Miguel is saying that they are going to start work this month na on that Bulacan airport. So very exciting here. That's going to still be servicing Manila, of course, in 5 to 6 years pa. So medyo patagal pa. But nevertheless, another very interesting thing to be watching out for here is that Ramon Ang says he's interested in returning to the airline business by the time the airport will be operational. So what he says is that probably not now, but for sure, or not necessarily now, he said he's definitely looking into it. I will get into airlines, mark my word, but 6 years from now. So maybe not necessarily right now, but still, just to recall, San Miguel had briefly entered already into commercial aviation. It bought into Philippine Airlines, but eventually, and that was 2012, eventually sold the stake back to Lushotan in 2014. He actually said that he believes demand for air travel would be back to normal eventually, while costs would be lower. So what is his expectation for the airport in Bulacan? Initially, it will have 2 runways when it opens in 5 years, and then will be 4 runways in the 6th year. Now, other things he is saying that expansion projects of San Miguel, so those will be new breweries, toll roads, elevated rail, will continue as planned. In fact, they're planning to raise as much as 20 billion pesos from the sale of preferred shares to fund its infrastructure projects. Take a look at SMC, down, however, by 0.1% to below 100 pesos, 99 pesos, and 90 centavos, Jess. And finally, I just want to take a quick peek at the telcos area here. Just because we were talking about this for quite a long time, and how those stocks have been the ones really moving the market here. And this from an analyst, from analysis from Bloomberg, they're saying that the movement of several companies like Now Corporation and Dito were really because of the Converge IPO. And that has been sparking a volatile rally. This, according to Phil Stock's financial analyst Piper Tan, some in the market have speculated that Converge could seek the business combination with Now or Dito to expand. But he does say investors should stay away from these stocks for the movements are highly volatile and very, very speculative. So in fact, Now Corporation jumped 26% yesterday. It's now pulling back a touch. It's down by 5.4%. Dito, meanwhile, jumped 13% yesterday. That is now pulling back by 6%, Jess. Another thing I just want to add, Jess, sorry, but one
Sure,
last
go
thing.
ahead, go ahead.
This from Eduardo Año. He's of course Interior Minister. He says the
Mm-hmm.
LGUs are now complying with President Duterte's order to act on telco tower
Right.
application. So he said that they're now approved permits. Those have risen to 1,171 from just 574 last week. He says, I don't think telcos will have reason to say that they are facing difficulties.
All right, lots of
Okay.
developments on that front, right?
Yeah, Jess. So a lot of things going on when it comes to equities, but of course we have to take a step back and take a look at the general economy and how that's still doing. A lot of reports, especially from multilateral organizations, saying that the pandemic is crippling businesses and the economy. This, according to a World Bank study, they've got some painful figures. Break that down for us.
All right, it's precisely the point is the bleeding continues for local firms here, and a lot of the companies are still not at 100%, despite of course quarantine measures already being eased. Like what you mentioned, this is from a World Bank study back in July. This is in cooperation with the Finance Department and NEDA. They did a survey of 74,000 companies, and if you try to take a look at the results here, it would show that overall of the 74,000 companies that were surveyed, 40% actually had to go through a temporary shutdown, whether that be government mandated or voluntarily. And what's interesting as well, those closed companies, 45% actually have no clue as to when they will reopen. Also, looking at the other figures here, 15% of the companies had to go through on a permanent lockdown na, so closed shop na talaga. And at the same
Mm.
time, 45% or only 45% were able to reopen. Now, of those which reopened, only 5% actually did so at full capacity. And quite a number of them are unsure as to how long they will remain open. Some of them are thinking that maybe this will only last 3 months for them at least. Now, if we try to take a look at things on a regional basis here, it would show that 70% of the firms in Cebu actually had to go through some form of closure. Now, around for the areas in NCR, Calabarzon, and even Central Luzon, 57% of the companies had to go through some form of a closure as well. At the same time, it would show, the study did show that there was a plunge in sales and demand. However, for sales at least, there was a bit of a pickup here, at least for July. Drop in
Mm.
sales was just at 64% compared to the April figure of 89% plunge when it comes to sale. However, for demand, that has fallen by 50% for one of three companies and due primarily to mobile restrictions. And in turn, that results to companies actually wanting to cut costs. That means less operating hours and at the same time reducing their workforce or resorting to digital solutions. In fact, one of two firms have reduced wages. Nearly half of them have cut jobs, and mostly these are from the education sector as well as food services, as well as in the construction industry here. And according to the World Bank study, pessimism really much persists here, at least during the July period here, with a high degree of uncertainty remaining felt in BPOs, in food and retail, as well as transportation, rental, and leasing. Now, 23% as well actually remain positive for sales growth. That's on the upside here, especially in the electronics and utilities sector. In fact, 10% of them are considering their outlook for the remaining quarters.
Okay, Jess, I think we're getting some connection problems here. But as you mentioned,
All right.
pain persisting here. A lot of uncertainty in firms, even if the reopening is so low compared to their full operational capacity. This, of course, will have negative effects in employment. A lot of pain here, job cuts in the region as well, not just in the Philippines. Who
Mhm.
are the most vulnerable to these job cuts?
All right. If you try to take a look at this study from the Asian Development Bank and the International, the teenagers are most affected here. We're looking at 15 million jobs in 13 countries in Asia and the Pacific. They are warning of a lockdown generation being left behind. That's, of course, after Asia has relied heavily on a young population and a growing middle class to drive demand. And that pretty much is being threatened here because of the crisis here. In fact, Asia Pacific has accounted for two-thirds of global growth in 2019, and that is expected to contract for the first time since the 60s. And the World Bank is saying that the new poor in Asia Pacific will reach to 38 million. 2 million of those will be from the Philippines, and it's worse than the previous job crisis here. The bright spot, however, the technology space as a sector still hunts for young people to beef up their workforce. They are expecting as well an acceleration in the gig economy, but not all, of course, they are expected to thrive in an informal work environment.
Okay, well, hopefully the situation is just temporary, and once that technology sets in, we can get back those people back into the workforce. Thank you, Jess. Checking in on the headlines we're keeping our eyes on. Credit card billings plunged by 27%. That's in the first half of 2020 as the usage dropped amid the pandemic. The Credit Card Association of the Philippines President Alex Ilagan told the Philippine Star that the high unemployment rate and loss of livelihood took its toll on the industry. Ilagan explained the health crisis made it more difficult to settle credit card debt, and clients were hesitant to apply for new cards. He added that the high percentage of unpaid debt has forced banks to allocate a significant amount for loss provision, which pushed credit costs to unprecedented levels. Borrowers severely affected by the crisis are entitled to a 60-day grace period under the Bayanihan 2 law, while banks will soon face an annual interest rate cap of 24% for all credit card transactions starting November 3rd. Now, this from the Philippine Star. The Finance Department has ordered key agencies to formulate a joint strategy against cybersecurity threats. This comes as the government fast-tracks its digitization efforts as under the new normal. Agencies instructed to come up with a unified cyber defense strategy include state-run financial firms, pension funds, insurance agencies, and revenue agencies. Finance Secretary Sonny Dominguez stressed that cybersecurity is a national concern as it is needed to protect citizen information. The World Bank, on the other hand, has pledged its continued support to the country's digital transformation. The World Bank stressed, though, that there are obstacles that the country needs to overcome, like improving internet connectivity and implementing reforms in the investment environment. The Transportation Department is expecting to finally award technical service contracts for the Metro Manila Subway project. That's by the month of February. Transportation Assistant Secretary Goddess Libiran said the bid submission and the opening of technical bids for the project's E&M systems and track works contracts are scheduled for November 12th. Recall that the first phase of the subway project covers three packages. It's rolling stock, electrical, and mechanical systems works, track works, as well as the construction of the first three underground stations and tunnels. The 17-station subway is slated to start full operations in 2025, but the government is already planning to launch partial operations by the fourth quarter of 2021. Now, moving on to new updates regarding another subway project, private developer Philippine Infradev is issuing shares to the local government of Makati as part of its joint venture agreement for the 10-station Makati subway. The SEC has just approved its application for the valuation of Philippine Infradev's convertible preferred shares. That company will be issuing over 650 million convertible preferred shares that's valued at 6.57 billion pesos to pay for Makati's properties. The property space has been one of the hardest hit during a nationwide lockdown where people are unable to go to offices or even spend time in retail spaces. However, the residential segment seems to be staying resilient as bargain hunters swoop in. Here to share with us his views, we have Colliers' Senior Manager for Research, Joey Bondoc. Good morning, Joey, and welcome to the stream.
Morning, Danie.
Joey, before we dive into the residential segment, I just want your general sentiment on the property space. Has it been better than was anticipated in the first half of the year? Has the numbers become even more bleak? Is the recovery starting to take longer? And with all of these closures, which were of course expected, like the Pogos leaving and all of that, are people actually swooping in and buying? Are the closures being filled, or is there even more pain ahead?
Unfortunately, Danny, we're not seeing good figures at this point because if you look at the office market, we're seeing higher vacancy. The last time I was interviewed, we were projecting a vacancy of what, about 5.5%. But now we're looking at a 7% vacancy for Metro Manila office because, as you know, a lot of companies have closed shop. Some of them are now working from home. So office absorption is really affected. The retail, of course, is not doing very well. We see a lot of
Mm.
vacancies all over Metro Manila. And in fact, we are looking at a double digit vacancy, about 12% by the end of 2020. Hotel, of course, is again not doing well. IATA is saying there will be a recovery 2024. So that's about what, 4 or 5 years from now. Industrial, of course, logistics is doing well at this point because a lot of people have been relying on the deliveries. And in fact, some logistics companies have been modernizing their facilities. But I think an upside, Danny, for the property market is we were pleasantly surprised with what we saw with the residential market. I mean, for the
Mm.
first half of 2020, we saw a net take up of about 20,000 units all over Metro Manila
Wow.
in the pre-selling market. And that is not bad because in the first half of 2019, pre-pandemic, we saw 22,000 condominium units sold in the pre-selling market. And if you further dissect that, the share of the mid-income segment, these are condos priced starting at 3.2 million and higher, ultra luxury from 20 million and higher. The share even grew to about 90% from about 80% previously. So, and the share of the lower price segment, affordable segment, 3.2 million pesos per unit and lower, actually shrunk to only about 16% from 26% previously. That's why this somehow supports the central bank's finding that residential prices in Metro Manila increased despite the lockdown and pandemic.
All right, Joey, let me just jump in very quickly here. This is just by the way. What do you think is driving that take up here, especially from the mid income to the luxury segments here? I mean, does that have anything to do at least with policy measures from the BSP, interest rates remaining low? At the same time, you have these property developers at the same time coming up with different schemes to at least aid probable buyers.
That is correct, Jess, because a lot of developers have been, recalibrating their sales strategies. A lot of them have been shifting to digital selling, online selling, and that, of course, contributed to higher sales. You're correct. We also saw very affordable, attractive packages being offered by these developers. I mean, you now see in the market ready for occupancy units being offered at about 5 to 15% discount, and then the down payment
Okay.
5% can be stretched in 3 to 6 months, and you can move in already after completing that 5% down payment. We are seeing less reservation fees. Some developers are offering laptops, are offering appliances for
Wow.
every
Mm-hmm.
condominium units. Also, they've been really aggressive and creative in terms of their selling strategies, and of course a lot of broker sellers have also tapped the demand that we are seeing in the market. This only indicates that there is indeed liquidity in the market,
Mm-hmm.
and whether it's an
Mm-hmm.
upscale, which is 6 to 8 million pesos, mid-income 3 to 6 million, or an ultra luxury 20 million and higher, there is still take up, and it's just a matter of um, extending affordable as well as attractive and flexible payment terms to clients.
Joey, what about the rental yields,
Okay.
especially those that had already bought the properties before, and a lot of tenants, like a lot of pogo workers, had, for instance, left during the lockdown. Is this correction something that was already expected by the market? Since even before COVID, naman there was an expectation, and there was a sense that the yields were exceptionally high because of pogos. Is this expected, or is this something to do with the COVID pandemic as well? And what's the situation going to be in the future?
Well, similar with office rents, Danny, the yields for residential rents are not doing well at this point. Of course, those condominium units that were initially being offered to POGO employees, of course, a lot of them have been vacated already. I mean, if you look at the office market, we see a lot of office spaces, even PEZA proclaimed offices being vacated by POGO tenants. And of course, this is spilling over to the residential market. A lot of condominium units are now being vacated. You see several business districts such as the Bay Area, which initially primarily catered to POGOs, but a lot of units are now being vacated by POGOs and are now being resold or leased out at a much lower rate. If you look at the
Mm-hmm.
prices for a condominium, so our projection is that there will be a 10 to 15% drop by the end of 2020. And then for lease rates, we're projecting a drop of about 5% for 2020 before a slow recovery
Okay.
starting 2021.
All right, Joey, at the same time, it would be very interesting to note where is the take up primarily here? Are we still talking about a Metro or Manila centric a market here, at least a property play? Or are we seeing developments as well in the rural areas? At the same time, the type of investments here, do people still prefer condominiums over house and lots?
Well, that's an interesting question, Jess, because if you look at the Metro Manila condominium market, as I mentioned, the take up for the first 6 months of the year is not really bad. I mean, 20,000 compared to 22,000 a year ago. But what we have noticed is that a lot of investors have also been looking at areas outside of Metro Manila. In fact, we had this July 30 briefing at Colliers International,
Mm-hmm.
and we did a mini survey. And based on the survey, the results of the survey, more than 60% of residential investors are looking at properties outside of Metro Manila, and some of the more attractive areas are Cavite, Laguna, Batangas. You also look at
Mhm.
very attractive residential projects in Pampanga, for example, Bulacan, Tarlac, and these affordable mid-income residential projects are doing very well. It's not just house and lot or condominium, but even the lot only projects, because we believe that in the near term, a lot of millennial workers, young employees, even BPO and OFWs are trying to save money and trying to buy their own lot only projects that eventually they can build,
Mm-hmm.
design their own house. So the trend has shifted partly to bigger open spaces, healthier office or condominium buildings. We now see a greater demand outside of Metro Manila, and we believe that this demand for residential projects outside of Metro Manila will be sustained even once the pandemic wanes and the market sentiment recovers.
Interesting. So move into the bigger spaces here, farther and farther from the central business district. Joey, last question on the developers. Were the bigger developers more resilient during this crisis because they were able to diversify, or were the smaller players that were really focused on residential able to do much better than the bigger players? And also, to what extent is there a percentage of completion towards planned, and to what extent were there delays in terms of construction?
Well, it's a mixed bag, Danny, because if you look at the previous crisis, Asian financial crisis, the well-diversified developers were the ones that were able to recover quickly after the Asian
Mm-hmm.
financial crisis. I mean, they have recurring income generating assets, retail. But of course, as you know, malls are not doing well at this
Mm-hmm.
point. But there are also some smaller developers that boutique developers that are doing good at this point, and they're able to post really good sales take up. Now, in terms of completion, of course, we're seeing a lot of delays because the pandemic, the lockdown affected the construction sites. I mean, a lot of developers had to test their employees. They had to house their construction workers in a single site, and there were some physical social distancing protocols within construction sites. So those really affected the construction of condominium units. Also, some developers are trying to save cash and
Okay.
generate more a greater cash flow. So some of them really delayed their projects. Just to give you an idea of how much has been delayed, but at the start of 2020, we were projecting 14,000 new condominium units in Metro
Mm.
Manila. But now for 2020, we're only likely to see about 6,000
Wow. Okay.
condominium units complete. So that just tells you the amount of projects that were delayed and will be delayed for 2020.
Thank you so much, Joey, for those insights. As you mentioned, still a lot of challenges for the sector, but still also a lot of bright spots and new trends
That's
here.
right.
Thank you for your
Thanks,
insights.
Danny, Jess.
Thank you, sir.
And that's a first look into the business day. Today is October 7, 2020. I'm Danie, Laurel.
Catch us again tomorrow at 9:30 a.m. I'm Jess Delos